Hi everyone and a very good evening. You're watching The Money Show on ET Now. I'm Ubina Kapasi. This is the show where we talk to you about all personal finance news, views and opinions that you need to know. This is the show dedicated to personal finance in every way. So if you have any questions or queries regarding your portfolio, regarding the mutual funds you own, or any other question on how to efficiently manage your money, shoot them to us. Our email address is themoneyshow@etnow.tv. Well, let's tell you what we have lined up on today's episode of The Money Show. First up, as the Nifty is at a lifetime high, what should be your mutual fund investing strategy? What is a good strategy to create wealth? And additionally, what's interesting is the Amphi data has indicated that investors continue to redeem more mutual funds in equity as well as in debt as well now than invest. So what exactly is the reason behind it, and what should be your strategy in the midst of that? We'll be bringing on board Brijesh Dalmia to talk about that. Later on the show, a very special ET Now conversation with the who's who from the hiring industry, SIS India as well as Quest Corp. A conversation we had about what the jobs market is looking like now, what are the skills you need, and the adaptability to work from home for different sectors, which are the sectors as well that are currently hiring and the most in-demand skills. So we'll get you a slice of that conversation. Petrol prices, meantime, approaching 100. And finally, we will also be reintroducing rather our special The Wedding Edit segment, where we'll be speaking to Vikram Mehta of Empire Weddings for our Spend with TMS segment to talk, and this one especially for those individuals who are set to get married. What are the boundaries? What are the do's and don'ts for getting married amidst these uncertain times? So lots lined up. First up, let's tell you all the big headlines at this hour. Spike in crude prices continues to pinch pockets. Petrol and diesel rises for the 7th straight day. Petrol now trading very close to 100 rupees per litre. LPG too gets dearer. Well, markets meantime are on a roll at the start of the week. The Sensex conquers 52,000. The Nifty gains over 100 points to 15,300. And the Nifty Bank gains over 1,000 points as banking stocks lead the bull charge. The volatile, breathtaking Bitcoin rally continues, but some profit booking seen now after the cryptocurrency pushed close to $50,000. The Bitcoin is up more than 60% now, and this year, and 1,100% since the low in March last year. Supreme Court tells Facebook and its messaging app WhatsApp that it will have to intervene to protect people's privacy in the wake of the latter's new policy. The development comes in response to a fresh plea alleging lower standards of privacy for Indians in comparison to European users. In the latest on the Centre versus Twitter face-off, the Modi government mulls making coup its first port of communication with the public. PM Modi too is expected to join coup shortly. Meantime, it's a historic decision by the centre as the government deregulates map making and generation of geospatial data. Private players have the freedom to handle this information without prior government nod. The data will remain only with Indians. PM Modi says this reform will unlock tremendous opportunities, generate employment, and accelerate economic growth. Maharashtra sees a sharp surge in COVID cases and records over 4,000 positive cases and 40 deaths in a day. This is the highest since the 6th of January. Maximum City records 600 plus cases in the last 24 hours, and the second round of vaccination begins in the state from today. Well, crypto investors and traders certainly do have a reason to rejoice, as the Bitcoin, the world's most popular cryptocurrency, has surged towards yet another milestone. It's just, of course, fallen a bit short of the $50,000 milestone, as the Bitcoin over the weekend saw a ton of development in terms of news, in terms of pricing action as well. So yes, the cryptocurrency hit a record high of $49,694, just a few dollars short of the $50,000 mark. And over the weekend, we had a lot of news flow. First up, Morgan Stanley, via its investment arm, which is, by the way, of $150 billion, so it's a big investment arm, is planning to bet on Bitcoin. Secondly, BNY Mellon is now planning to service cryptocurrencies for its clients. And thirdly, Canada has given the nod for the first ever Bitcoin ETF. So just around Bitcoin, there are at least two news pieces which are indicating that there is a big bank out there who's willing to bet big on Bitcoin. And the second is that we are going to be seeing a Bitcoin ETF very soon. This is indeed very interesting because it sort of shows the kind of faith that big corporates, big institutions have on the crypto. And if that happens, then certainly retail investors as well are keen to put their faith in the cryptocurrency. So all of this is something that has pushed the cryptocurrency higher in a very significant manner. BNY Mellon, of course, says that they are planning to service cryptocurrencies for the clients. So in all probability, they'll be creating a separate cryptocurrency of their own. But, just to remind our folks of two important news pieces. One, the clear volatility in the prices of Bitcoin. Remember that the whole idea behind the Bitcoin and the reason why it demands $48,000 and $49,000 is because it's going to be in limited supply. And secondly, is the fact that in India, we have the overhang of the cryptocurrency regulation bill. We are not sure what sort of form and shape it will take. There is a probability that it may be banned. And, some reports were suggesting maybe a transition period will be given to existing crypto investors and traders for 6 months odd. And that the government will have, regulated cryptocurrency that will be launched. So these are the two things, especially as Indian traders and investors, that you should be wary of. Okay, but what else is rocking along with Bitcoin are the markets, with the Nifty and the Sensex at record highs. But interestingly, despite the move in the markets, there are more and more mutual fund investors that seem to want to press the redeem button more than the invest button. This has been the case for equity mutual funds. Guess what? In last month's AMFI data, we saw this happen even for debt mutual funds. So what's the reason behind this, and what should your investment strategy be as in India the equity markets gather momentum? We have with us a very special guest, Brijesh Dalmia of Dalmia Advisory, joining in. Brijesh, thank you so much for taking our time to join us on the Money Show today. So to start with, Brijesh, when we are in a bull run, when the equity markets are rallying, everybody talks about it, right? I mean, in fact, they say that when everyone starts talking about the markets, that's when you should be a little fearful. But I think that seems to be the case clearly for a lot of equity mutual fund investors, because in overwhelming numbers and month after month, we are seeing more investors redeem than invest in the markets. So what explains that according to you?
Well, thank you so much for calling me on the show. Thank you so much. Mubina, this is nothing new. And small investors, retail investors, new investors tend to book profits very quickly. And when markets go up, they think that it will not go up again and it will correct. And a lot of selling pressure is there from the so-called novice investors. who like to take the profits away and sit idle for some time. And because of this, in a rising market, you will definitely see a lot of redemptions, which mutual funds will face. And some of the investors also may have been nearing their goal, and because of which they need money, maybe in the next 6 months, 1 year or 2 years, and they tend to book profits so that in case markets are not performing well in the next 6 months, 1 year, they can actually take their money out now and do not lose out in the case markets fall. So this is nothing new. This is very, very systematic process of the equity markets where smart money, the so-called smart money, remains invested, and a part of the general public book profits a lot of times. So in all the bull rallies, this is what happens, and after they miss the rally, they come back again.
Okay. But do you think then that's the right strategy that is being deployed by these MF investors, Brijesh?
Absolutely not. But you can't help it because there are millions of investors, and they all think differently. And me being in the financial markets for the last 25 years, I have seen this cycle repeat over and over again. We have seen it with our investors, our clients who are young, who are new. And there's a huge difference between someone who has been investing for the last 10, 20 years and someone who has been investing for the last few years. And this is not a right strategy because what happens, Mubina, is that when markets fall, people do not sell generally. And they stay to the level of 20, 30, 40, 50% of market fall, and they lose 30, 40, 50% of their capital. They remain invested. But when markets go up, they tend to book profits or come out of the markets the moment it goes up by 10, 20% or 30%. They do not wait for 50%, 100%, 200% gain. So this is not a wealth creation strategy at all. This is absolutely very amateur in nature, and one should not do this.
Okay. What about debt mutual funds? Again, if as a retail investor, I see that, for so long we had been seeing net inflows in debt mutual funds across categories. And now suddenly in January, we see net outflows over there as well. So what essentially explains that? And also I ask you this question because, we've been reading a lot of reports about how this may not be the year for debt mutual funds because, interest rates are going to stay steady. Plus, we had all the action coming in from the budget as well, which will maybe give some sort of guide to how debt funds could move from here on. So, what explains the net? I mean, do you think that explains the net outflows in debt MFs, or is it just the end of the year kind of phenomenon which causes corporates to, redeem?
So I think you're right. End of the year is still a little bit far away. In the month of March, the advance tax will come on 15th of March. So that is still 1 month away. But definitely, it has mostly to do with the fact that interest rates are on the upside. I think the market feels and institutions feel that they probably will not see further reduction in the interest rates in the marketplace. And because of the budget, because of the increased borrowings, interest rates have inched up, which puts a lot of pressure on bond prices. And NAV of many medium-term to long-term debt funds have gone down a little bit, maybe by 0.5%, 1%. So what happens is that a lot of big money, which is there, who tracks the market very, very closely, and any such indication, if that money is for short-term, let's say 1 month, 3 months, or 6 months time, it can have a very negative effect on the portfolio. So a lot of money which has gone out from the system is actually big money. Investors who really think that the debt returns will be poor this year and interest rates may not go down. So the clean period of the debt market, so-called, has been over. And as you rightly said, 2021 may not be the best time for debt mutual funds because a lot of mark-to-market gain has already arrived because of softening of the interest rates in the last 12 months. So in spite of COVID, which is not a very good thing to happen for the mankind, but for some reason, both equity market and debt market in the year 2020 has outperformed. They have given superlative returns. And debt funds might be under pressure this year. And because of this interest rate rise, and there is no signal which is there which can put ease to the interest rates, it can actually fall a little bit, maybe 10, 20 paisa here and there, but eventually interests are going to be stabilizing at this level. So a lot of short-term money which came as well as institutional money has gone out from the system in order to look for better revenues. But I would like to add here, Mumina, if you stay invested for, say, 6 months, 12 months, or 18 months time, this 0.25% up and down in interest rate, 0.5% up and down in interest rate will not affect your portfolio to a large extent. This is because you might see a little fall in the mark-to-market prices of your investments in mutual funds, but then again, the coupon, the yield on the investments will go up, which will compensate a fair portion of the mark-to-market which goes down in the because of the interest rate rise. So for short-term investor, yes, it's a very difficult time for the debt fund. But for somebody who's looking for 12 months, 24 months, 36 months, I don't think they need to do anything at all.
So for those individuals, let's say, who are in short-term debt funds, the short duration funds, or maybe even liquid funds for that matter, what would you advise then?
So the suggestion is pretty simple. You have to identify your time horizon. So if your money is for 1 month or 2 months, I think liquid is the only place where you should invest. You should not look at making extra returns on your investment on debt fund and taking a market call on interest rates. But if you're thinking about maybe a year or 2 years, then I think you need to remain invested and you can actually put more money. There's no problem because of the recent rise in the interest rates. Probably your returns will be a little better if you had invested 2 months ago or 3 months ago. And if you are thinking about 3 years or 5 years and your objective is to beat bank fixed deposit and you are investing your money in debt fund by pulling out from other debt products, then I think there is absolutely no worry. The only worry is that if you are investing in a medium term or a gilt security or a banking PSU fund for 3 months to 6 months and your time horizon too short, and if market interest rates go up, then you are in trouble. So probably you will lose some returns on the portfolio. But short-term debt funds, I think there's nothing much to worry about.
Okay, understood. All right. Well, you know what? We'll do one thing. We'll take a very short break on the show. In the meanwhile, I'll tell all our viewers that, you can always email us on The Money Show at etnow.tv. We're monitoring the email address and we can take forward any questions or queries you may be having on the topics that we discussed with Brijesh right now on the show. So shoot them in. For now, we'll take a very short break. Brijesh, request you to stay on with us. We'll be back. Back, you're watching The Money Show on ET Now. We're in conversation with Brijesh Dalmia on using mutual funds. What should your investment strategy be as the markets hit a record high level? And of course, we also discussed some of the data that we saw from the AMFI for January. But it's time for The Money Show, Ask The Money Show, where, of course, we're inviting our viewers to send in their questions and queries. We've got quite a couple of them in, but let me just one by one ask them. First up, we have Narayana Prasad, who asks a question saying, I'm an NRI presently investing only in banks through fixed deposits. I wish to invest in other possible ventures, but don't have much knowledge about it. Can you please provide guidance? All right. So, Brijesh, currently for NRIs, what are the other investment vehicles available for them in India?
Well, apart from some debt investments like gold bonds or PPF, they can actually invest in a lot of places. Mutual fund is one of the most preferred vehicle for NRIs to invest in India. And I think Mr. Narayana should consider investing a part of his investments and savings into mutual funds. What he can do is that while NRE fixed deposits, if he's doing NRE fixed deposit, that is a good investment because that is tax-free. So while that is a good investment, he should also probably consider doing some SIPs in diversified equity mutual funds. And if he's thinking about a lower risk, probably he can go for a lump sum investment in a balanced advantage fund category. So on a limited basis, whatever I know about him in your show, I can suggest him to look into mutual funds. I think that should be a good opportunity for him.
Okay. Well, our next question has just come in from Darshit. He shares his fund portfolio with us. So this is a new query, Brijesh, that has come in. He says that he has roughly about 6 funds and he has been doing an SIP in these 6 funds for the last 2 years. I think his goal is wealth creation and, a good place to park your money so that it doesn't lie idle. So there's 10,000 rupees in the Axis Blue Chip, 5,000 in the Axis Mid Cap. Then there's the Parag Parekh long-term fund, a very talked about multi-cap fund in which he has 2,500 rupees. And then in the small cap space, he has 5,000 rupees in the SBI small cap, 5,000 in the Mirae as emerging assets blue chip fund, and 5,000 in the Mirae asset large cap. So largely, if we have to look at his portfolio, there are 3 large caps, 1 mid cap, 1 small cap, and 1 multi cap, or as we call it, flexi cap now. How would you view his portfolio, his investments? He's got a good amount of money as well going into SIPs. So, from what I see, it's almost 32,500 rupees every month that he puts in mutual funds. So what do you think of his mix of portfolio?
I think he's doing good. Primarily, SIP is a good vehicle to invest in the equity markets, and he has been doing SIPs. So that's a good way to invest. Secondly, the type of funds he's investing, I am okay with this. His selection of fund is quite good. The only change probably or addition I would suggest is probably he can look at one index fund or maybe a large cap fund to properly diversify his investments. Otherwise, he's doing well.
Understood. Well, I think let's take on board our third query then for today. Shashank Pandey says, I have 50 lakh rupees invested across 20 different companies, and so that's direct investments, and he also has 5 lakh rupees in mutual funds. So 55 lakh rupees put in equities as a whole. Now his aim is that he wants financial freedom. He has 30,000 rupees per month of income from rent and farm. He's 28 years old, got married 3 years ago. He has 2 children, 1 boy and a girl, wants to work for another 7 years, and he can save 60,000 rupees per month. He's got 20, okay, I think there seems to be, okay, and I'm assuming he's got some salary as well, so that's the reason why he's saying that he'll be able to, save 60,000 per month. He's not shared how much he earns in his salary, but he does say that he has 25,000 rupees as expenses every month. Could you please guide me? So I think at 28, to be able to get a 50 lakh rupee portfolio is not bad. I reckon some of it may also have come from his father, from his ancestors, I suppose. But yeah, 55 lakh rupees in equity as a whole. I don't think he has any other investments. But, at 28 and then wanting to sort of maybe retire in 7 years, of course, he has that steady rent and farm income as well. How wise do you think that is, Brijesh? Do you think that as his current investments and his income streams stand, he would be able to achieve this? Or is 7 years too short a time frame?
Firstly, I must say that at 28 years, if he is thinking about saving and retirement and trying to be disciplined to make an investment portfolio, that's a very good thing to do. Very few people actually think like this, and they have a good portfolio. And at 28 years, with a salaried income, if he's able to create a 50-60 lakh rupees portfolio, that is pretty good. Regarding his investments, I think, he has mentioned that, he's saving 35,000 rupees every month. Probably a part of that money should go to SIP in equity mutual funds. He also needs to consider whether he has any debt portfolio or not. If not, and the entire 55 lakh rupees is into equity portfolio with a 7-year horizon for retirement, I think he needs to play a little safe here because markets are at all-time high, and if he has no safety net around him in terms of his debt investment, then I think that is not a very good thing to do. So probably his future investment, or by booking some profit from his equity or mutual funds, he should think about parking some money into debt, and he can choose the kind of debt product he would like to invest. Of course, a product like NPS or PPF may not be very suitable for him if he wants to retire in 7 years' time, but otherwise debt mutual funds or maybe some kind of other debt product he can do. The only change which I suggest in his case is that he is more in equity and less in mutual funds. So unless he is an expert in stock picking and he knows exactly what's happening around the stock, it is fine. But if you don't have time, do not have much research to do on stocks, I would suggest to probably reverse the order, that you can have 5-10 lakh rupees of direct equity because you want to expose yourself in equity directly, and have a maximum exposure through mutual funds. That will be a better strategy, safe strategy, and probably more effective. This is what I can suggest him, yes.
All right. Okay. Well, Brijesh, on that note, we'll let you go. Thank you so much for joining us today on the show and, patiently answering all the questions and queries that we've received from our viewers as well. Thanks so much for joining in. And remember, ladies and gentlemen, you can catch this entire conversation on ET Now's YouTube channel anytime, anywhere. So keep a track. We'll be uploading this entire conversation very shortly on ET Now's YouTube channel under the Money Show playlist. For now, we'll take a very short break on the show. But when we return, we'll be getting you a gist of what's the employment situation looking like in India. What are the sectors that are hiring? What are the most in-demand skills that you probably need to either learn or brush up on? So don't go anywhere.